I'm really grateful that John, Charles, and Jesse are going to speak a little bit about regulations. IXO, I made up that term, means IEO, STO, ICO, IDO, and a lot of the newer alternative fundraising methods. And so I'm going to let the panelists introduce themselves.
I'm Jor Law. I'm a corporate securities attorney, and the last couple of years I've been taking a pretty prominent role building out infrastructure for security tokens. This has included tokenization of polymath, issuance and secondary trading with T0, and kind of back-end solutions and payment solutions for Prime Trust and a couple other companies in the space.
Hi, I'm Charles Kaufman. I'm a corporate and securities attorney with Lexcuity PC in Los Angeles. And we're a firm that has specialized in alternate finance for several years. And we were very early proponents of equity crowdfunding when the Jobs Act rules came out, and got very involved in advising companies on how to pursue that. And then when STOs came along as sort of the killer app for crowdfunding, we were early adopters or early participants in that area as well. And we advise a lot of companies in how they can take their plans for digital assets and turn them into ways to raise funds from investors.
Awesome. I just wanted to start with a disclaimer that all the information that you heard today is not legal advice. And if you are looking for an attorney, you have to seek one for yourself that represents your project and you. And also, we're not providing the investing advice as well. So just kind of take note of that. And these are our views only and doesn't represent any of the projects that we represent. Okay, super awesome. I wanted to begin by talking about Atlanta and the food that's available in Atlanta. So of course I came here yesterday and I was just like really jet lagged because I came from Dubai, and I was looking for a place to eat. So I went to, I had Mexican, and it was actually pretty good. However, I think some of my panelists have different experiences. So we're just wanted to begin to talk about food and and its relationship with IXO.
I didn't think you're really going to ask that. That was a facetious comment. But I thought, just in case she asked that question that I meant as a joke, how could I tie that into blockchain? And I think the idea for me, maybe, and this is a pure BS answer, but IXOs don't work for everything, and they don't solve every single problem. And this is also true of blockchain. Just because you have a problem, it doesn't mean if you add blockchain to it, it suddenly is worth a lot of money or it solves the problem. And I think one of the themes you'll hear throughout tonight is that this IXO concept, especially in the US, it's not for every project, it's not for every deal, it's not for every person. And even if it could technically be done, it's not necessarily the best move.
I was hoping that Jor would have some insight on how blockchain could help give greater food alternatives at midnight when you just get off a plane and you're on a highway strip hotel somewhere. That would be for further discussion. I did have my first meal at the Waffle House, and it wasn't bad.
You
Me too.
So, how many people here, just to gauge, and to not go over familiar material with the audience here, how many people are kind of familiar with the ICO movement of a couple of years ago and how that's evolved into IEOs and STOs? So about half. So let me, without going into too much detail, try to give some background. Beginning maybe 4 or 5 years ago, and up until about 2 years ago, where it really reached a peak, blockchain assets and blockchain ideas, like we've heard from the previous panel, people got very excited about using new blockchain assets as a way of raising capital. parties would come up with an idea for a new type of coin or cryptocurrency that would work in a particular industry or with a particular business. They'd write a white paper. They would go to investors and say, this token doesn't exist yet, but we're working on it. It's going to be fantastic. You can buy a right to get it at a big discount now, and then when we issue it, you'll get it and you'll make a lot of money. And there's a desire partly because of the kind of subversive ethos in the crypto world, and partly maybe out of naivete. People did not realize that these were securities offerings, that they were raising money, where people would have an expectation that their investments would pay off for them because of what someone was doing. Ultimately, a lot of these promised coins were never issued, and that activity in that form came to a halt in November of 2017 when the SEC lowered the boom in what was called the Dow report, DAO. And they basically said most of these, if not all of them, are securities. They need to be either issued in an IPO or in a recognized exemption from registration with the Securities and Exchange Commission, and that they may go lightly on the older ICOs, but from that point forward, any of them would be subject to SEC scrutiny, and a lot of SEC enforcement actions did follow that point. So it was kind of a rude awakening for the industry, and people realized that they needed to treat these digital assets, at least in their pre-offering form, as securities. They needed to do private placement memoranda and follow the SEC regulations to privately place or crowdfund an offering. And the security token offering was born. Instead of the ICO, it was the STO, a security token. Still a digital asset, but one that people admitted was a security, at least for regulatory purposes, and tried to issue in accordance with SEC regulations. And we've been struggling, we were struggling for a couple of years with clear guidance from the SEC on when we had to follow those rules, and when an issuer could say, I've got something that's not a security and I don't need to go through those hoops. It's more like Bitcoin or Ether than like a security. And we did get some guidance on that earlier this year. So we had ICOs, which in their original form don't really exist anymore. STOs, security token offerings, and then we've got something new called the initial exchange offering, which is an evolution of the ICO where the coins or tokens are released to the public or initially sold at the same time that they actually become available on an exchange for trading.
Yeah, I think it's important to note that in the U.S., the ICO and the IEO, the initial coin offering and initial exchange offering, there is a good chance that most of them effectively will be some sort of securities offering, so that you don't truly have ICO, you don't truly have a IEO. You'd have to be really, really careful before you do one of those in the U.S.
And what are some, in terms of ICO and pre-sale and the IEO, which is hosted by the exchanges, usually outside of the United States, what are some of the trends that you have seen and some of the issues and best practices regarding initial exchange offerings?
Well, since it's sort of the hotter topic, the IEO is maybe the one to address first. We did get guidance from SEC on when you can sell something as not being a security that's a digital asset. Last July, there was a digital asset framework that was announced, and there have been some no action letters. And basically, you have to be issuing something that's a currency or utility token. The digital asset has to exist. You can't be selling a promise that you're going to issue it in the future. And it has to have value based on its use in commerce, not on people speculating that it's going to go up in value. So, and if it's not a security, it can trade on a crypto exchange, like Kraken or Binance or any of the many crypto exchanges out there, doesn't have to trade on a stock market or stock exchange or securities exchange. And the rules are easier outside the U.S. So if you're doing an IEO, and you very few have been done in the U.S., but if the idea was to do it in the U.S., you would have to have a utility token that was already basically up and running that people were buying for some purpose other than investment. It could already be used for video games, or it could already be used to exchange it for airline miles, some token that, and people were buying it and paying an amount for it that was related to that. And that's really the only basis that it was trading on. Then you could do an IEO where it would be released onto an exchange for immediate trading because it's not a security, and you could even do it in the U.S. Because the rules tend to be more lax outside the U.S., most IEOs are done there. A digital asset that's even doesn't have a ready market, that people are buying for speculation, that people are pre-buying, those can be sold and traded on exchanges outside the U.S. And you have to be very careful if you have any contact with the U.S. Or you're based in the U.S. that you structure this so it's not deemed to be an offering in the U.S. But the IEO can take place in a jurisdiction outside the U.S. and begin trading on a market there.
And just because it's not a securities doesn't mean that other laws don't apply. If it's not securities, there is a high likelihood that some other law, like money transmission or et cetera, applies, and those are not necessarily friendlier than securities laws.
Yeah, and I wanted to ask about Charles and Jor about jurisdiction issues. So I think outside the U.S., SEC usually doesn't have jurisdiction in reach. However, a lot of the founders are based in the U.S. The servers may be in the U.S. And there were a couple cases where the SEC listed a number of factors in technology that could be based in the U.S. So what are some of these best practices and factors to consider if you're a non-U.S. company incorporated somewhere else with U.S. founder, and AWS, Amazon, has services inside and outside the country.
So, one of the things to think about, of course, is that if you're an American citizen and you go to Singapore and you graffiti some cars, Singapore can come and cane you. And if you're a online sports site and you do gambling and you take a flight that connects to JFK, U.S. can arrest you. And even if you don't connect to the U.S., they could try to extradite you. And both of these cases have happened before. I think there is a misunderstanding that just because people are outside of the U.S. in a favorable jurisdiction, that somehow the U.S. doesn't apply. And that is not exactly true. If you're not in the U.S., if you're not doing business in the U.S., if you're not attracting business in the U.S., you're not focused on doing business in the U.S., yeah, probably U.S. law is not going to apply. Or if you accidentally hit the U.S., probably someone looks the other way. But if you are overseas and still targeting the U.S. because you've sold to the U.S. or you've allowed and facilitated trading into the U.S., then of course the U.S. laws are still probably going to apply.
Yeah, so if another example beyond gambling would be cannabis. If you're doing any kind of an offering that relates to cannabis, Singapore is not the place to do it. One of the things that I think Michelle was referring to is the Tezos case, where and there was another similar case where the SEC listed these factors that led them to conclude that the offering was taking place in the U.S. And not only was one of the factors that the servers that the web purchasing mechanism was on were located in the U.S., but also because I think it was an Ethereum-based transaction, the verification sites, that cryptographically verified the transactions on blockchain, because a majority of them were based in the U.S. They said that was another factor making the sale in the U.S. And that would be something very difficult to plan around and would affect a lot of of offerings based on a lot of different blockchain technologies. Fortunately, what Tezos didn't do, but what any offerer who's trying to establish that their offering is outside the U.S., we have what's called a safe harbor of Regulation S. And if you meet the requirements of that safe harbor, you're going to be seen as conducting your offering outside the U.S., even if you're accepting payment in the U.S. and even if you have service in the U.S. So to take a step back, as aggressive as the SEC may be, the Securities Exchange Commission, as much as it may seem like they want to grab onto every enforcement opportunity, under the Constitution, they cannot regulate purely offshore transactions. And all the securities laws have an element in them that says you have to be using the means of interstate commerce to fall under SEC regulations. You have to be using telephone lines or radio communication or the internet, something else that's a means of interstate commerce. And but there is also a policy underlying the securities laws that if a U.S. company wants to raise money overseas and truly is just doing it overseas, it shouldn't be at a disadvantage to local players in those markets raising money there. So this safe harbor under Reg S was created. Basically, you need to make sure that the purchasers are not U.S. persons. You need an AML KYC process to confirm that they're not in the U.S. If there's any aftermarket trading, the securities are not supposed to trade for a year, and you're supposed to have a way to police that. If they do trade in that year, you would have to know that they're on a trading medium that restricts U.S. purchasers or blocks U.S. purchasers. There's no way those securities can flow back into the U.S. So if you follow the offering restrictions and you make sure that you are dealing with an offshore purchaser, and if the purchase is deemed to take place outside the U.S., which basically means they're outside the U.S., your company can be here and take the money here. But if the purchaser is over there, you can structure it under Regulation S, and you can play in the same waters as non-U.S. companies and raise money under the same rules.
Yeah, and Regulation S, it's just an exemption. So what you have to do is kind of understand, the limits of that exemption. A lot of people, when they talk about Regulation S, talk about Rule 903, and that's effectively just a primary issuance exemption. So if you're looking for Regulation S to apply to some other things like Investment Company Act and things like that, that Regulation S, that's for the offshore transactions, that doesn't apply to every single type of securities transaction. So it's very important to understand what it does apply to and what it doesn't apply to. And that's the thing for Regulation S that you have to be careful about.
Okay, so I think every one of us went to high school probably, and we had different grades. So since we talk about S, there's also A plus, and D. So why don't we talk about D first, and then we'll move to A plus.
How do you do it?
Sure.
Awesome.
So, there's this basic concept, really, of securities law, whereby, if you sell securities, and generally if you're raising money and taking investment, it's often with securities, then you have to register them. And the idea of registration is to, give adequate disclosure and prevent fraud, right? And, some people came out and effectively said, well, but that can't be in every single case. What if it's my mom? What if it's someone I'm very close friends with? What if it's someone that's really rich? Certain types of investors maybe don't need certain types of protection. And Regulation D is, there's Rule 504, Rule 506, B and C. Those are the core ones. It used to be a 505 that got eliminated and combined with 504. But let's talk about 506 because that's what most people do. The idea behind 506 was that, well, if it's a private transaction, then maybe, we don't need to protect the people quite as much, and we should have some exemptions because, these are all my buddies anyway. And then the question became, well, how do I know it's a private transaction? And the SEC effectively came out with Rule 506B, which had a series of steps that basically said, well, if you don't generally solicit and you don't advertise, and you go after people who are accredited investors, generally, they have a long list of non-accredited investors that people don't really use. Then, if you do this, and this, then we'll consider this to be a safe harbor for private transactions. And for a long time, and still to this day, that is by far the single biggest method of raising capital in the U.S., trillions of dollars each year. And that's been true for the last couple of years. Every single year, that's how most companies in the U.S. raise money. In the last few years, a lot of people came out and said, well, look, we want to be able to generally solicit. What do you care if we're taking accredited investors anyway? And, there was some, rhyme and logic to that. So they came up with 506C. And 506C effectively was the same thing as 506B with largely two nuances. One is that you could generally solicit and advertise. Radio ads, TV ads, buses, pitching at conferences, no problem. The downside is that you could only take accredited investors, and that wasn't that big of a downside because in 506B most people only took accredited investors anyway, but you had to verify that they were accredited investors. I co-founded a company called Verify Investor, and Verify Investor's only goal was to provide verification for accredited investors for 506C compliance. And the reason I had to do that is because verification is kind of annoying. You got to go grab tax returns, you got to go grab credit reports, you got to go grab information to actually prove that someone really is an accredited investor, right? So the implications are interesting. 506B, can't advertise, can't generally solicit. 506C, you can. 506B, if someone tells you they're an accredited investor, you can trust them as long as you don't have a reason to think that they're not. 506B, you can't trust them, you have to verify.
And I think it's hard to overstate the revolution, really, that 506C was. Because in private capital formation, you had this long-standing rule that you could only deal with people you already knew, were accredited, and you could not advertise or talk about the offering publicly. 506C, you could advertise anywhere on the internet, television, radio, as long as you take that extra step of verifying that your investors are accredited. And it's been a huge success. Regulation A, or Regulation A plus, comes from another, it was also part of the Jobs Act, but came from another direction. Basically, under the Securities Act, you're in one of two camps when you go to outside investors to raise money. The default rule is do an IPO. Hire an investment banker, spend several $100,000 to do a public offering, which doesn't really make sense if you're a new enterprise or these days if you have less than maybe $1 billion in potential capital.
Yeah, but it was cheaper than an ICO.
For some people, yeah, it could even be cheaper than the first few Reg A's were. But so there was that regime, and then it said, well, we've got these private offering exemptions, but you can only go to accredited investors, and you should not be able to do a general solicitation. And there was this big gulf between the two. Well, what about if you wanted to offer to ordinary non-accredited investors and raise some money that way, but you weren't ready to do an IPO? The SEC had a long-standing regulation called Regulation A, which was supposed to be kind of a smaller IPO. But you could only raise $5 million, and the requirements were still very onerous. No one ever used it. But what the Jobs Act did is they tried to resuscitate or breathe new life into this, and that's why people called it Regulation A+. If you look in the rule books, you won't find a Regulation A+, but it's better than the old Regulation A. You can raise up to $50 million. One of the big attractions of it is that in at least one form, it overrides state securities laws. So just as Reg D does. If you're not under one of these regulations and you do certain types of offerings, you also have to qualify with each state where you find investors, which could be a huge chore. So Regulation A, if you do what's called a Tier 2, overrides state laws. And what you sell in the offering, you can sell to ordinary non-accredited investors, retail investors, and the securities that you sell can be immediately tradable. And this, of course, is quite attractive in the blockchain space, because blockchain is all about transferability, fractionalizability, fungibility of the securities that are being sold or the assets that are being sold. So but the price of admission, and it's usually the price of admission at the SEC if you want to reach retail investors, is that the SEC has to review your offering circular. You have to have an offering circular in a specified format. In some cases, you need to have audited financial statements, and you're going to have to go through a review process with the SEC. Regulation A has been available for 2-3 years now, Regulation A plus for these types of offerings. And about a year or maybe a little more ago, security token issuers tried to file and sell security tokens using Regulation A or A plus, and they ran into a brick wall, or at least a very winding and slow path with the SEC. They were tied up in comments from the SEC for as long as a year. Their offerings were not approved. And we finally did get approval of 2 security token offerings earlier this year in July and in September. And if you want to take a look online, you could look at the Blockstack offering or UNOW offering, both of which are pretty ICO-like token offerings, but they're being done as securities offerings and raising significant money with SEC approval. And there's probably a dozen or 2 other offerings that are tied up in SEC comments that will eventually start coming online. But this has coincided with a lot of other infrastructure that will serve the desire to have these tokens be immediately freely tradable. One of the concerns of the SEC that held up these offerings so long in comments was they promised that there would be, or indicated there was likely to be an aftermarket trading for the tokens, but the SEC didn't understand how it would really work and that there would be enough assurances to protect investors. But in the interim, we've had alternate trading systems develop, which are kind of like stock markets, but at a lower level and with a lower requirement of disclosure that can trade security tokens. There are 3 operating under sort of a pilot system now. And there are also transfer agents, which the SEC likes to see, that are independent actors that ensure that the ownership and transfer of securities protects investors' interests, that they're not just going to lose their securities in the ether. So this should start becoming a very viable means for STOs, particularly. It's held up a lot of STOs as people really want to have that immediate liquidity, and they can get that now using Regulation A.
Introduction?
Yes. Okay. Hi, Jesse Hudson here. For those who haven't met me earlier today, hi, I see some familiar faces. Hey, everyone else. I'm an attorney in cryptocurrency and blockchain, as well as in cannabis and psychedelics. More in cryptocurrency and blockchain than in cannabis and psychedelics, because cryptocurrency and blockchain pays the bills more. But funnily enough, the offerings are very similar in both spaces. You have often a startup owner who has an idea and wants to raise money from investors. And the legal documents and the compliance, especially with securities law, it is very similar. The exemption that I want to talk a little bit about, and forgive me if you guys talked about it, is actually not Regulation D or Regulation A+, but an exemption that allows unaccredited investors and general institution in CF.
We didn't.
Okay, so that's the crowdfunding regulation, and that's for smaller offerings, up to just over $1 million, and these can only be done on a particular crowdfunding platform, something like Fundrise or more likely Republic Crypto or Start Engine. Another exemption that a lot of crypto people are drawn to, and that in my opinion was a big part of the incentive behind the whole offshoring movement in crypto, is Regulation S. And what Regulation S does is it creates a safe harbor. You can imagine S stands for safe harbor. As in offshore transactions for basically issuers that are selling to people that aren't in the US at all. And what the SEC is essentially saying with Regulation S is that we don't have jurisdiction over those investors that are outside of the United States, So we're not going to require you to verify whether they're accredited by their own country standards. We're going to expect that you're going to comply with that country's law because you're selling to people in China, and Chinese securities regulators are going to come after you if you don't comply with their law. But that's not our job, as the American securities regulator. But what that's done, that safe harbor, is it's created a motivation for companies to go offshore and do their offerings offshore so that they just don't allow U.S. investors at all, and therefore allow basically investors from any country at any level, accredited, non-accredited, whatever, to join the offering because it's an offshore offering in the safe harbor of Regulation S and potentially in the safe harbor of other countries' securities laws. And so what that means in practice is an offering like Mobius is a great example. A company from a Harvard law grad who also was a Y Combinator alum and moved his team to the Cayman Islands for the duration of the ICO in order to issue a token that was not issued to U.S. investors, but was then freely tradable afterwards. And his rationale behind doing so was that he was in the safe harbor and he was issuing an asset that wasn't issued to Americans and therefore shouldn't be subject to American securities laws. Never mind that he moved back to the United States afterwards and now runs his company out of the U.S. So there's an interesting quirk there, I think, that's worth paying attention to. How Regulation S and the drive to offshore ties into Regulation A plus and Regulation D, and how Regulation CF kind of ties into these smaller offerings. Just to ground it in what to me is the ethos of crypto, I believe in tokenization and full free tradability of assets. I mean, that's an ideal state to me is a state where we have many, many assets that are not securities, and we have a clear exemption for things that are issued that aren't securities, so that we have free tradability. Because this technology is so enabling for that kind of value transfer and that kind of tokenization in different parts of the world. That's the world I want to see.
Just to add, since we kind of covered the whole alphabet of these exemptions, you can combine a offshore Reg S with a U.S. offering under any exemption or registered in the U.S. You can do those concurrently, and a lot of people do that. So, for example, if you're doing an offering that requires people in the U.S. to demonstrate that they're accredited investors, but you don't want offshore investors to have to go through that hassle, you can do the offshore part under Reg S, and then just the onshore part under Reg D.
All right, you guys are welcome to ask questions. Just want to make sure that we're intimate. Do you have a question?
Yeah, I was just wondering, Estonia seems to be in a country. How does that play into all of this?
Well, I think I'll just make a quick comment. I definitely don't know about it as much as you guys, and I really defer to the knowledge of my colleagues here on the stage. But in my opinion, Estonia ties into this similarly to how Malta tied into it, or how Cayman Islands tied into it, how Singapore tied into it. These are jurisdictions where perhaps a U.S. company will feel safer issuing an asset that may not be considered a security, which is essential for the free tradability of your token within an ecosystem, right? If your token is considered a security, then your system is going to get clogged up by transfer restrictions and by transfer agents and the requirement to register the names and do KYC of all the people who are holding them. So I think Estonia draws people in because of its proactive approach towards blockchain legislation.
And Estonia is also actually not averse to cannabis issuances. So, in some cases like Estonia and other offshore, some of the other Singapore, some of the other offshore locations, there's been some more regulatory clarity there, and that also attracts people to those particular locations. One problem that we had with a client that did its ICO in Estonia is currency controls, and this is something you have to consider when you select an offshore jurisdiction. There are certain countries where money coming in from them is inherently suspect, and occasionally there'll be currency controls that completely block funds from coming from those countries. The banks either are unwilling because of the burden or just incapable of demonstrating that those funds came in without any risk of being from a corrupt source. And Estonia, I don't know if it currently is, but Estonia has been one of those jurisdictions. The former Soviet republics in general have that potential issue.
Michelle knows a ton of the folks in Estonia, so if you're interested in Estonia, definitely talk to her.
I'll tell you how suspect it is, right?
Yeah, she's suspect. But look, Estonia is, internationally, and Estonia is one of these places. A lot of the regulation has been friendly toward crypto. Don't necessarily confuse that as friendly toward security tokens. Even the jurisdictions that are friendly toward crypto, such as Singapore, etc. If it's very clear that it's a financial instrument that is like a securities or like securities, especially if they already have a securities regime, then the more rigid securities regime would still come into play. Estonia is interesting though because they are fairly crypto friendly, and there's a possibility, you have to see kind of how you kind of fit into the Estonian laws, but there's a possibility of passporting into the EU. And if you can fit in under Estonia and passport into the EU, that becomes kind of compelling. You still have to deal with the banking issues and et cetera though.
So I'm a EU resident of Estonia and also visited the country this year at a retreat. It was related to startup and leadership. Also had a friend who was an Estonian lawyer. So if you guys have any questions about Estonia, let me know. So my next question is really regarding the framework given by the SEC. So if you're not, even if you're not a U.S. company and you're outside of the U.S., some of the framework requirements look at whether you have a system in place, whether there's a product, or the tokens, or could be used and ready to be used. So I've seen some IEOs without even a beta or alpha. If you're doing an IEO outside of the country, do you still need to have a product?
Depends whether you touch the US.
Yeah, it's going to, if you touch the U.S., then you will, and you don't want to be deemed a security, then you'll have to have a product, and there'll have to be a ready use for the token.
Yep, nothing really more to add there. Yeah, it's but if I may,
Sure.
This subject of IEOs is very interesting to me, and we were talking about it earlier with some members of the audience because of the difficulties with it and the potential issues that you run into from a regulatory perspective and from a business perspective. So I look forward to talking about those as well.
Yeah, and in terms of there being a ready product or the token network being up and running, this relates to the desire to have tokens that are not securities and that don't have to, that can be really easily and freely tradable like a digital asset should be without having to be on a stock market or ATS or any SEC regulated exchange. And the SEC always held up the possibility that something could be like that and said that Bitcoin was an example of something that's not a security. Ether, once it was up and running, not a security. So the question was, how do you get into that category instead of being in a category where you have to follow SEC regulations? And if we were having this talk a year ago, we would be talking about reading the tea leaves from SEC speeches that have been published and other very loose guidance. But finally in July, we got the SEC published its digital asset framework. It really laid it out. And surprisingly, since the SEC started to regulate these assets 2 years ago, the Howey test and an old Supreme Court case related to the SEC called Howey versus the Commissioner became a household word, and because that had the rules in it for, are you a security or are you just a thing, an asset that's not a security, and SEC has no business regulating you. And they did finally put out in clear form how to distinguish one from the other. One of the key factors is your system up and running? Is the network up and running, or are you selling people something that you're going to make? What the Howey test is based on, you have an investment contract. If you're selling something and the purchaser has an expectation that they're going to make a profit or value from the efforts of another. So all those, they went into great detail with digital assets and what makes those three things apply. So for the efforts of another, they created this new category called, what's an AP? Associated person,
Yeah.
who is, it's someone who's going to actually, an active participant. An active participant is someone who's going to be ongoing with the digital asset and doing things to give it value that you're relying on when you buy that asset, as opposed to something that's decentralized and gets its own value from the marketplace. And the presence of a active participant weighs in favor of you having to be regulated by the SEC instead of having a currency or a utility token, something that's just a thing.
Yeah, and active participant is like a crappy thing because like that just came out of the blue. They just created this new concept. Charles actually has a good article on active participants. If you Google Charles in the word or Kaufman, an active participant, there's a good article that kind of summarizes who might be an active participant or not. Question?
You all touched on something that I would say is a little bit counter to the way my understanding was over a year ago. And you said that your token actually had to be out, ready, made, and trading for tradable, and that and that kind of bypassed.
I think what they meant to say wasn't so much that the token was tradable, because obviously the ICOs, the RC20s were out there.
Because they were on ICOs and then afterwards created tokens. After they sold all of them.
I think the idea really meant that the ecosystem was up and running, and that the tokens had a actual use within that.
So we had produced our droids May 4th of 2018. May the 4th be with you. These are the droids you're looking for. And at the time, we were still in development with we are still in development with a lot of the ecosystem, but with the main parts that were there. So one of the things that, because we were making the tokens, we still didn't transfer it out, but anybody that, we still didn't sell them, we gave some away, but we did also make our conference, you could buy into the conference with our token if you had it, just to make sure that we had some use case for it. Do you think that was would that have worked if we got pulled in front of the SEC, or is that just too?
I think the best thing, honestly, is pull up the framework. It's actually fairly easy to read, and there's a bunch of questions in there. And what they look at is kind of an ecosystem effect. So like the fact that your tokens have some utility is helpful, but some utility is not necessarily enough. They do really want to see that the network is fully up and running, and it's not. Reasonable minds could differ on this thing, right? They talk about this network being up and running and fully developed. Nothing's fully developed. Amazon's not fully developed. IBM's not. Nothing's fully developed, right? So in that sense, they erred on the side of being overly conservative, which is too bad. I understand why they did it, but it does put the rest of us in a precarious situation, because it gives them a lot of leeway to come after the fact to someone who, honestly, for a lot of, certainly there were people that knowingly did things wrong, but for a lot of people, they hired counsel, they relied on counsel. Counsel didn't know.
Oh yeah, we asked five
Yeah.
different attorneys, 5 different law firms,
Yeah.
and had 8 different
Yeah,
opinions.
the problem, and that's my problem with them. In general, I think the SEC's done a good job. In general, I think they've exercised discretion, but it's really tough, because that it's probably going to be the case where the SEC busts someone for breaking the law that the SEC didn't even know was illegal at the time that it was broken. And I think the SEC probably, they're good people. They're not out there to screw the market.
You're sure about that?
I'm
We
positive about
quote
that.
you. I'm going to tweet that.
I'm positive about that. So they want to preserve the capital markets and protect it as well, and not just chill it. So they've been careful. They could have busted Ethereum. They could have busted DAO. They
How
chose
could
not
they-
to.
I mean, really, there is no company behind it. The theory.
There were enough.
There were developers. There were people
Yeah,
that were
if they
working
wanted
on
to,
it.
they probably could have gone after some of the developers, right?
Yeah.
Right.
You're right. Things like that. They definitely could have gone after some people, and they chose not to. And some of the enforcement, cases, it looks like they targeted, either a massive fraud or a small company just to send a message to the marketplace. It could have gone for more. They started off going after fraud first,
Which
when
is
it was
the right thing.
easier to go after registration and things like that. And before they did any of that, they shot warning shots. They gave guidance. They gave speeches. They gave warnings. So in general, I think they try to do a good job. I don't think they purposely go out and try to nail that person. If someone in good faith complied with the law and tried to hire good attorneys to try to do it, the likelihood of them going after that person religiously is probably less.
Right.
I-
Well,
But I'm an optimist. So
we held back in doing an ICO, and really got full blessings from the attorneys to do it after I finally laid out. Now this is the ecosystem we're modeling, and it's ludicrous for somebody to buy our token on speculation because it's a stable token. And he's like, "How? Show that to me." And I laid it out exactly how it's should be modeling Magic Gathering Online exactly how it would be stable. And they're like, "Oh yeah, you're right. It's ludicrous for somebody to buy it on speculation."
And that's
so
where the
therefore,
factors that would definitely help people.
Yeah.
therefore go forth and prosper.
the interesting thing
And we also had product ready and going.
Right, and the interesting thing is in the current global environment, something that's stable could actually be considered an investment because a lot of people are making investments just to maintain the value of their, so people are issuing out $0 bonds and things like that, and that's being sold. It's being sold in the millions and billions. Those are investments. So it's interesting when it's just stable. It's,
We're taking the Magic the Gathering Online ecosystem, the exact ecosystem, and placing it on the blockchain and expanding to the whole video game industry. And that's just to protect the consumers from getting ripped off as they do now. And the Magic the Gathering's had a stable currency since 2002.
Yeah.
Another point is that you can purchase stablecoins through OTC, so you can purchase it off the market. So it could be an investment because of that. Corey, I think you have a question.
Not necessarily a question, just a comment on the SEC. And I'm sure those attorneys out there have spoken to SEC attorneys and lawyers several times before. And some of the higher end people. I think a lot of people in this space in America, we're getting this massive image that the SEC is bad people. He mentioned that too, but it's not like that. They want to foster innovation. They want to they step back a lot of times and let innovators do what they naturally do. So it's one of those things where it's like a hit and miss sometimes, so where I've seen a lot of companies in the startup space, they put so much emphasis on what is the SEC going to do, how do I try to get around it, and I think it inhibits them from their growth of their startup. And just speaking with a lot of those high-end attorneys and lawyers about it many times, they're like, we don't really care what you guys do. Like, they don't even target a lot of companies anyway. They don't even have enough big enough staff to go after everybody. But I think what has happened, and this, especially I was in the ICO space initially when it started, speaking of attorneys, like they had no clue what was going on. And what happened was a lot of companies just didn't do anything because they were so afraid of the SEC. In your case, in your company as well, it's like one of those things where like you have to do what you can do till you get to a point where somebody tells you to stop. And that's what they was trying to push with the SEC. Like the origins of the SEC, I don't know anybody know the history of the SEC. Anybody ever researched that? How they were established. But
Well, they were established during the Great Depression after the crash of 1929, and they relied on the work of really a couple of authors who they looked at the British Companies Act and they looked at everything that had gone wrong that had led to the crash. And frankly, they looked at the New York Stock Exchange, which was considered the safest market at that time and the best regulated, and looked at making the protections that sophisticated investors expected to get on the New York Stock Exchange available to all investors. And one of the first directors of the SEC was Joseph Kennedy, who was famous for having pulled his money out of the market just before the crash, and who was said to have basically known where all the bodies were buried, or to have known how people got away with cheating investors, and he used his leadership of the SEC to close off some of those problems, like the short swing trade rule, that if you make a if you're an insider at a company, you make a profit by buying and selling within 6 months, you've probably taken advantage of inside information. You have to give your money back. But the clarity that we've gotten since this last summer in July, no action letters and the framework, they all came from a newly created office of the SEC called the Center for Financial Innovation, or FinCEN. And the people there and others at the SEC, they come to conferences like this and listen to what's happening in the industry. And they don't maybe always get it right, but they are really trying to not stifle innovation. And there is the fear that they're just going to drive the activity outside the U.S. if they over-regulate.
But they have driven
To some extent, yes.
Yeah, because we don't have clear, or hadn't had clear enough regulations, of what box can we play in inside the U.S. That was the problem, is there wasn't the known clear regulation.
Right, I understand. Usually, throughout history, when there's nothing clear, you do it until somebody tells you to stop. That's all I'm saying.
Well,
That's what happened.
That's what happens.
Exactly.
They got busted.
We're also locking people up for it, too.
Well, but the percentage of people that actually lock up and go to jail is very minimal.
But to be fair, I think some of the people knew, the people that went to these big firms and were doing these ICOs and somehow they were being told they weren't securities, those people came to kind of, I used to be at his firm, they came to our firm too. And we looked at them and we said, look, it looks like it's a securities offering. And they would tell us, and you're a small thinking firm, you don't know what you're talking about. We're going to this big firm. They've all told us it's okay, and we're just we don't understand how. They must be smart because we don't know what we're doing. And it turns out that we were right all along. So some of those people knew, I think.
So anyways, I've actually looked at big firms and small firms, and I just wanted to tell the community to really be careful. I've looked at the security corporation side, as well as the compliance for the SEC, as well as contracts and transactions from big firms. And I don't think that if you get a big firm, that means that they're right.
Yeah.
Okay.
Exactly.
I really do advise, and not legally, but to ask you guys to really ask questions and ask about their experiences, and use your brain and look at something and see, hey, that doesn't make sense. There's fraudulent lawyers as well, in this space, and we should be aware of that. But I do have a question for the panelists, and the question is, I'm in Jor's tokenization group, and he posts awesome things about security tokens all the time. And, when I'm bored in the morning, I read legal stuff, which has been super amazing. And one of the things that recently came out is about broker laws. And so if you're a consultant without a broker license versus if you're a broker, what are the line between that and the nuances?
Honestly, it's tough. I'm a consultant myself, and I'm paranoid about this because the lines are not always exactly clear. I did write an article, of broker dealers and finders and things like that. I didn't write that article with a view toward consulting versus broker dealers, but the questions that come up are similar. So if you can Google that article, you can find it. The other place to look at would be the SEC's website. It has something called Guide to Broker-Dealer Registration. And even though it's a guide to registration, the first part of it is talking about, when are you a broker and things like that. There are certain questions, and effectively, if you're helping kind of affect the securities transaction, then you're a broker. And that what that means, that could be broad, it could be narrow. Like there's some things that clearly in SEC's eyes makes you brokers. For example, if you take a commissioned based compensation, right? Transaction-based compensation, they call it. But really, if you take a commission on capital raise, then they assume that you're a broker. I don't know that that's necessarily the right position, and I think in some other cases the SEC is possibly wrong. Like sometimes I think they overstep their international jurisdiction, for example. But even if they're wrong, that's not something you want to, you don't want to fight against the government. So that's one thing to think about. And the part is that they'll ask these questions, and they'll seem to be yes/no questions. They'll be like, "Do you do this? Do you do that?" And they're designed to be kind of yes/no questions. But if you think hard about it, it's maybe. And then if you think further about it, you could say yes to any one of them except for the transaction-based compensation one, and say no to a few other ones, and then maybe overall you're a yes or overall you're a no. And that's what makes it really difficult, I think, because if you provide business plan writing services and you only do that, then pretty clearly you're probably a business plan writer. If you provide economic services and you provide tokenomics studies, you're probably very clearly just an economic study person. If you provide marketing, you're probably just that. But if you suddenly do all of that and you do it with respect to an STO, then maybe, are you suddenly, did you cross the line to being a broker? And the answer is maybe. And that's where I think there's gray lines that I don't think anyone knows what the answer is.
Yeah, and the prohibition in particular on transaction-based compensation, success-based compensation, paying someone money based on each sale or how many sales there have been of the asset is so strong that even within a company, you have to be concerned about that. So normally, a company that wants to sell its securities directly has no risk of being its own broker-dealer. It's called the issuer exemption. And crowdfunding has made it much easier for companies to sell their own securities directly online. However, that exemption doesn't apply to employees of the company. And if you were to give an employee of the company a bonus for each 1,000 tokens you sold, or a bonus based on volume of securities sold, you may well be making that employee into a broker-dealer. And if you have a broker-dealer involved in a transaction that's not registered, enforcement is two-pronged. The SEC will go after the person who's engaged in illegal or unregistered brokering activities, but they'll also go after the company for aiding and abetting that person in being an unregistered broker-dealer. So you don't want to go there. But one thing to also point out is that in the hedge fund world, there have been a lot of people who probably were broker-dealers operating for years or decades that SEC has not gone after at all. But that doesn't mean you're safe if you run afoul of the rules.
What's the fine line between the company offering it and the employee offering it? Is it like a CEO, CFO, officer level, or
no one can do it? No one can get transaction-based compensation without being a broker. So your CEO cannot get like, hey, here's X dollars, but if you raise this much money, here's X more.
Oh, I got you.
But even a CEO wouldn't be free from
Right,
that.
I see the
Let me ask you guys a question. What if the company is incorporated outside the U.S., the founders are here in the U.S., and they hire someone from Asia or something to raise money, and the percentage is up to 25%?
Oh, that's interesting. I don't know that that's settled. I know what a lot of law firms say and allow, but I don't know that it's 100% settled.
Yeah, it depends on whether the person acting overseas and only acting overseas is deemed to have a presence in the U.S. Because there's two sides to the brokering transaction. There's the purchaser side, but there's also the issuer side. And if they're active with the issuer in the U.S., they may be seen as brokering here, particularly if they're an employee of a U.S. company. If you hire someone in that circumstance that's independent and they're offshore and they don't have contact with the U.S., you're okay.
Okay, what if,
And then you could also look at something called 15A6. If you Google Rule 15A6, it talks about certain circumstances where an offshore person can work with a U.S. broker-dealer and get an exemption that way.
okay, what if a person is negotiating an IEO in the US? Employee negotiate all the IEO deals for the US founder located in the US and the company is incorporated outside the US.
Well, I think that's clearly solicitation in the U.S.
Yeah.
One more issue I wanted to highlight here with enforcement for this kind of action is not necessarily from the SEC side, but from the investor side. If you have an investor who invested in your company as a result of an unregistered broker-dealer bringing them in, and the investment doesn't do well, that investor can claim what's called the right of rescission, which is a really powerful contract right, which means you basically put it back to as if the contract never happened. So you have to refund all of their money. So, important to be cautious of also these private rights of action that can result from activity like the use of unregistered broker-dealers, not just SEC action.
And in some places, the unregistered broker may have liability for that too.
Yeah, I have one last question. And the question is, what is the future of IXO?
It happens.
What I would really like to see is the DAICO model being adopted and like a decentralized, semi-anonymous IXOs being run on decentralized exchanges that are semi-anonymous outside of regulatory jurisdiction. I know that's kind of a weird thing for me to say as a lawyer, but it's something that I really hope crypto enables, is that kind of anonymous free transaction. And therefore a kind of exchange in an IEO space that enables anyone to participate in any offering with the rules of torts and contracts law ultimately governing the behavior of market participants rather than the rules of any particular market police.
But doesn't that already happen if you use Ether to buy an ICO or a token? I mean, is that what you're talking about?
It could, right? But if you're doing an IEO, you have to go to an exchange, usually where you do KYC in order to open an account. But that said, you could use Ether on a decentralized exchange for a decentralized exchange offering, similar to what Vitalik is talking about with the DAICO model.
The difficulty, the concept of that is kind of cool, and to the extent that it was truly decentralized, it'd be hard to enforce against that. So the only way they could enforce against that would be to enforce kind of institutions that support it or investors. In practice, it's difficult because these things don't just happen themselves. Tokens don't create themselves and end up on decentralized exchanges themselves. So usually there's someone involved, right? So if there's someone involved, then there's someone can go enforce against, and that's where the rubber meets the road. Theoretically, I suppose if a whole bunch of people wore masks and were behind kind of privacy networks, etc., and were able to do this such that nobody knew who they were all like little Satoshis, then theoretically that could work. Otherwise, the second they can tell, like, aha, there's a Vitalik here, etc., then there's someone they could target.
And one more point on the future of IXOs is, I think part of the future of exchange offerings is going to be clarity as to the nefarious nature of many of the market participants on the exchange side. Exchanges are often profiting in ways that are uncouth from the companies that are being listed on their platforms. And I have a client who's in a major dispute with an exchange because the market maker that the exchange recommended has controlled the market of the token, accumulated so much of the token market share, and then threatened to do various actions to tank the price of the token unless the company pays back all the money raised from their IEO to the exchange to buy the tokens back from them.
Yeah, I've heard of that. He was talking about that.
So that, I think, proof of stake deals, I think, is considered a bigger risk. One thing that I think is pretty clear about the future is that security token offerings will just be security offerings. Within a few years, probably all stocks and bonds and conventional securities will be recorded on the blockchain because it's just so much better than the current way that securities that are publicly traded are held. And then the innovative part of it is tokenization of securities will allow interesting new types of rights or features to be built into the securities. Voting is, for example, going to be much easier, and payment of dividends, if it's a dividend-paying security, should be much easier as well.
So I used to help a public company to comply with Sarbanes-Oxley and had to file these SEC documents onto Edgar. So I'm hoping that blockchain could change all that to make it easier. I mean, there were some code in there, seriously. Nice. But I'm really thankful and grateful that Jor, Charles, and Jesse are here. So why don't we do them?
Yes, thank you.
Thank you.